That was Treasury Secretary Scott Bessent on Squawk Box, touting great inflation numbers after the president has repeatedly called for Fed Chair Jay Powell to not just lower rates, but also to be replaced as Fed Chair. But our next guest says firing him could actually push inflation higher. Let's bring in Greg Ebb. He's the chief economics commentator at the Wall Street Journal. Greg, it's good to see you. And I assume because, you know, the whole idea you run policy looser than you're supposed to, you get high rates, higher inflation, and so forth.
Yeah, that's right. I mean, let's think about why independence in a central bank is important. You have all sorts of arms of the government conducting different policies, whether it's fiscal policy, credit policy, tariff policy. These have different implications for inflation. But at the end of the day, the Fed has really one job: to take a look at all those factors hitting the economy and make sure that in the end we have 2% inflation. Now, consider a world in which the Fed is really just another part of the government instead of independent from the government. The priority of inflation gets mixed in with all those other priorities. Is it going to focus its interest rate actions on inflation, or does it have to consider something else, like keeping down the cost of the national debt? And I think that compromising of its objective will, in time, work its way into the way the Fed behaves and what people expect from it. Kelly, I'm not saying that if Powell goes or there's some disruption this week that we'll suddenly have markets collapse and inflation shoot higher. That's not what I'm saying. What I am saying is that you chew away at the institutional underpinnings of the financial system, and that you, in time, not overnight, but in time, you pay a price for that.
Right. And again, I think Bessent denied that these discussions were being had, but it wouldn't surprise me. I mean, Greg, what do you think is going on with yields lately on the long end? Is it I need like the Greg Ebb Japan bond yield, like the big, like 3-page, Wall Street Journal weekend breakdown or something. Do you think that's part of it, or is it because of fiscal, or is it because of concerns about the next Fed chair?
There's a little bit of all those things going on. So first of all, where we are on the 10-year today, which is I think somewhere like between 4.3 and 4.4, it's lower than we were in January. So anybody who thinks that there's some kind of like panic going on, they need a reality check. What we're seeing is like wiggles around the margin. But I think a general statement you can make is that over the last few months, what we've seen is that expectations of Fed tightening over the next few years have gone down because the inflation numbers, as Secretary Bessent correctly said, have been good. And so that implies the Fed can, in fact, ease somewhat more than people might have expected just a few months ago. And that's reflected in the 2-year part of the curve. But what you've seen simultaneously with that is that the steepness of the curve, that is the difference between the 2 and the 10-year, has gone up. The market is telling you that they want additional return to take on the risk of longer dated treasuries. Why is that? I think there's a few things going on. One of them could be the fact that we're now looking at very large deficits as far as the eye can see. The Biden administration certainly didn't seem to take the long-term debt problem very seriously, and we haven't seen any evidence that the Trump administration is any different. And then just in the last few weeks, I think that this fear of independence at the Fed is a factor. If you parse the TIPS data, the inflation-protected securities data, very carefully, as a lot of folks on Wall Street do, you can start to see that a few years from now, once you're through all the tariff effects, people are starting to price in slightly higher inflation. And I do think that reflects some concern about the independence of the Fed.